The story is simple. It is compelling. Every 4 years, Bitcoin's supply issuance is cut in half. This event supposedly kicks off a predictable price cycle. A bull market, then a bear market. Then we wait for the next halving to repeat the pattern. This narrative provides comfort in a volatile world. But this map is outdated. The territory has changed. The strict 4-year price cycle is a myth. The proof is right in front of us. Recently, price made an all-time high months before the halving. The old pattern broke. To understand why this myth persists, we must define the halving. The first reason the 4-year cycle is unreliable is that the market has changed. It has matured. Bitcoin was once a niche playground for cryptographers, cypherpunks, and a few daring retail investors. The market was tiny and illiquid. A single buyer could swing price. A programmed supply shock felt like a tidal wave in a small pond. Today, Bitcoin is a global behemoth, a multi-trillion-dollar asset class. Daily trading volume dwarfs early cycles. It trades 24/7, worldwide. Participants now include hedge funds, pensions, public corporations, even sovereign wealth funds. Their flows follow allocations, risk models, and macro, rarely a halving date. Institutional programs can create steady buy pressure, breaking the old frenzy pattern. Early markets were sailboats moved by halving winds. Today's market is a supertanker. Engines, navigation, and schedules matter. Wind is just one factor. The market has grown up, and its behavior is more complex. A simple 4-year rule can't explain a mature market. Second, modern information markets are hyper-efficient. In Bitcoin's infancy, news spread slowly via niche forums and mailing lists. Information asymmetry let early believers position before others. Today, information spreads instantly and globally. Halving dates are predictable years in advance. Analyses, models, predictions, everywhere. Algorithms scan data and trade in microseconds. With efficient markets, the halving tends to be priced in. Traders act months ahead, smoothing impact. The event can even become a sell the news moment. Like a hot earnings report, you don't wait until the release to buy. Buying pressure happens before the event. The market starts running before the starting gun. That fundamentally alters cycle timing. Third, the 4-year model ignores the wider macro world. Bitcoin does not exist in a vacuum. It's deeply connected to the global economy. External forces can override, mask, or amplify halving effects. Shifts in U.S. interest rate policy change risk appetite. Low rates push risk on. Higher yields pull capital to bonds. Geopolitics and pandemics move markets. Currency shifts and stock market cycles matter too. These catalysts don't follow a halving clock. In 2020, the halving coincided with massive stimulus and zero rates. Liquidity lifted stocks, real estate, and Bitcoin. Predicting by calendar alone is like forecasting weather without the radar. The halving is a season. Storms can arrive anytime. Investors must track the whole sky of macro. Look beyond Bitcoin's internal clock. Fourth, miner behavior has transformed. The halving's most direct effect hits miners. Revenues cut in half overnight. Early miners capitulated. Hash rate fell and selling spiked. Today, mining is professional, corporate, and global. They plan years ahead, lock energy, upgrade hardware, build cash reserves. They hedge with futures and options. They can pre-sell production to lock prices. They borrow against holdings to cover costs. Selling becomes smoother and less predictable. Different strategies disperse supply over time. The supply shock is managed, not abrupt. Impact diffuses across months, not a single date. Public miners run finance like enterprises. The old post-halving stress cycle is broken. Expect a new, steadier baseline of supply dynamics. Fifth, the market's structure has radically transformed. Exposure no longer requires direct coin purchases. Early on-ramps were few and technical. Now we have direct futures and spot ETFs, regulated futures and options on major exchanges. Spot ETFs let anyone with a brokerage account get exposure. This opens vast pools of retail and institutional capital. ETF demand follows regulatory and launch timelines. not halvings. Massive 2024 inflows pushed price to highs months before the halving. ETFs alter price discovery with large visible orders. Arbitrage links ETF shares and spot Bitcoin. This superstructure didn't exist in early cycles. New events, players, and flows run on their own clocks. Complexity overwhelms a simple 4-year narrative. The old cycle is structurally obsolete. To summarize, the predictable 4-year cycle is an oversimplification. It fit when the market was young, small, and isolated. In today's mature landscape, it's a myth. The halving remains core code, scarcity, predictability. But its short to medium-term power has diminished. It's now one actor in an ensemble. First, explosive market growth. Second, instant information, pricing in. Third, macro integration. Fourth, sophisticated miners and hedging. Fifth, new products like ETFs reshape demand timing. Practical takeaway: broaden your perspective. Don't anchor to a calendar cycle. Track exchange flows, ETF flows, large holders, and miners. Watch the macro environment. The halving is a known tailwind, not destiny. Watch the entire sky. Use real data. Retire the myth and embrace nuance.